Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah, and today we're diving deep into American Airlines Q1 2026 10Q filing, released April 23rd. With me is Mike, our industry analyst. Mike, we're looking at a quarter that shows some concerning headline numbers. Negative $41 million in operating income and a net loss of $382 million on $13.91 billion in revenue.
Thanks, Sarah. If we reduce this filing to one sentence, it's this. American Airlines is operating as a structurally impaired legacy carrier, burning cash, while servicing a $22.93 billion debt load that represents nearly twice their quarterly revenue run rate. Based on this filing, American Airlines is operating in a structural reset phase. This isn't cyclical weakness. This is a carrier struggling with fundamental unit economics in what should be a recovering travel environment.
That's a sharp thesis, Mike. Let's test that against the evidence. Starting with material changes, what shifted most significantly this quarter?
Sarah, we need to acknowledge upfront that this is the first filing in our system, so we don't have direct quarter-over-quarter comparisons. But the headline metrics tell a stark story. Operating income of negative $41 million means American couldn't generate positive operating cash flow on nearly $14 billion in revenue. For context, healthy airlines typically run operating margins of 15%. American's operating margin here is effectively zero, actually slightly negative at negative 0.3%.
And that's before we get to the net loss of $382 million?
Exactly. The gap between the $41 million operating loss and the $382 million net loss tells us that American's capital structure is working against them. With $22.93 billion in total debt, all of it classified as long-term debt according to the filing, the interest expense burden is substantial. This creates a causality chain. If operating margins remain near zero and interest rates stay elevated, American faces persistent net losses, which erodes equity and forces either asset sales or additional borrowing.
Let's examine what management actually said about these results. What signals are you picking up from their commentary?
Here's where it gets interesting, Sarah. The MD&A section provided is unusually sparse on operational commentary. Most of what we have are standard legal disclaimers about forward-looking statements. Management stated that forward-looking statements speak only as of the date of the report, and that actual results may differ materially from those discussed. This defensive posture is notable. Management isn't providing much forward guidance or operational color.
That silence itself is a signal, isn't it?
Absolutely. When management goes quiet on operational metrics and forward guidance, it often indicates uncertainty about the trajectory. The one specific operational item mentioned was labor contract expenses, including what the filing describes as a one-time charge resulting from adjustments to vacation accruals due to pay rate increases effective January 1st, 2025, following the ratification of the contract extension in the fourth quarter of 2024 with our mainline maintenance and fleet service team members.
So labor costs are rising at a time when operating performance is already challenged?
That's the concerning dynamic. American is dealing with wage inflation while generating negative operating income. For legacy carriers, labor typically represents 25-30% of total costs. So wage increases without corresponding productivity gains or pricing power directly compress margins. The causality chain here is clear. If labor cost inflation continues while revenue per available seat mile stagnates, American's path back to profitability becomes increasingly narrow.
Let's shift to financial red flags. With $22.93 billion in debt and only $1.18 billion in cash, what's your assessment?
This is where American's situation becomes precarious. The debt-to-cash ratio of roughly 19-1 is extreme even for a capital-intensive industry. For context, well-capitalized airlines typically maintain debt-to-cash ratios below 10-1, and many target ratios closer to 5-1. American's $1.18 billion in cash represents less than 1 month of revenue coverage based on their quarterly run rate.
Is this a liquidity crisis in the making?
Not immediately, but the margin for error is razor thin. The filing shows American has access to revolving credit facilities, but here's the critical detail from the debt section. These secured financings are collateralized by assets, consisting primarily of aircraft, engines, simulators, airport gate leasehold rights, route authorities, airport slots, certain receivables, certain intellectual property, and certain loyalty program assets. American has essentially pledged their entire operating infrastructure as collateral.
What's the causality chain if cash flow doesn't improve?
If operating cash flow remains negative or marginally positive, American faces a liquidity squeeze within 12 to 18 months. They would need to either draw on credit facilities, increasing their debt burden, or begin asset sales. Given that their core assets are already pledged as collateral, any forced asset sales would likely be at distressed valuations, further weakening the balance sheet.
Moving to risk disclosures. What new risks is management highlighting?
The filing doesn't identify new or significantly escalated risk factors versus prior periods. However, the absence of detailed risk discussion in a quarter with negative operating income is itself noteworthy. Management did include standard language about various risk factors that may affect matters discussed in forward-looking statements, but they're not providing specific guidance on which risks they view as most pressing.
That seems like another form of management silence.
Exactly. When a company is generating negative operating income on $14 billion in revenue, you'd expect detailed discussion of operational risks, competitive pressures, or cost inflation. The generic risk language suggests management either doesn't want to highlight specific vulnerabilities or is uncertain about which risks pose the greatest threats.
Let's examine the balance sheet stress more closely. Beyond the debt levels, what other pressure points do you see?
The loyalty program liability is a significant factor that often gets overlooked. The filing shows $4.2 billion in current loyalty program liability, money American owes to customers in the form of mileage redemptions. This represents a substantial operational obligation. American must provide future flights to redeem these miles, but they've already received the cash from credit card partners.
How does that interact with their liquidity position?
It creates a hidden cash flow drag. While American has received cash from selling miles to credit card partners, they must now provide the actual flights. If load factors decline or they need to reduce capacity, fulfilling these mileage obligations becomes more expensive per seat. The filing notes that mileage credits generally do not expire as long as the A Advantage member has any type of qualifying activity at least every 24 months. So this liability isn't going away.
What about segment-level performance? Are there any bright spots?
The filing provides limited segment detail, but we can extract some geographic revenue data. American attributes passenger revenue by geographic region based upon the origin and destination of each flight segment. However, the specific regional breakdowns and margin data aren't detailed in the provided sections. What we do know is that loyalty revenue is principally comprised of mileage credit redemptions, and the filing notes that $4.2 billion of revenue was recognized in passenger revenue that was included in our air traffic liability at December 31st, 2025.
That suggests strong advance bookings carried over from year-end.
It indicates American had substantial pre-sold inventory, but converting pre-sold tickets into profitable operations is the challenge. Having $4.2 billion in deferred revenue suggests demand exists, but American's inability to generate positive operating income on that demand points to a cost structure problem rather than a revenue problem.
Finally, Mike, what should traders and investors be monitoring? And what would prove your structural reset thesis wrong?
Key monitoring points from management's perspective. First, watch the loyalty program liability trends. The filing shows this fluctuates with seasonal patterns. So Q2 and Q3 performance will indicate whether American can monetize their loyalty program more effectively. Second, Monitor their credit facility utilization. Any draws on their revolving facilities would signal accelerating liquidity pressure.
And your if wrong scenario?
What would prove us wrong? If American achieves operating margins above 8% in Q2 2026 while maintaining their current capacity levels, our structural reset thesis would be challenged. Specifically, if they can demonstrate unit cost discipline while growing revenue per available seat mile by more than 10% year over year, that would suggest cyclical rather than structural issues.
How does this frame the current valuation?
At current operating performance, this equity trades like a distressed turnaround story, not a recovering airline. The market is essentially betting on Americans' ability to restructure their cost base and optimize their route network before liquidity becomes critical.
Revisiting your core thesis, does the evidence support American being in structural reset?
The evidence strongly supports it. Negative operating income on $14 billion in revenue, a 19-to-1 debt-to-cash ratio, pledged assets across their entire infrastructure, and management's reluctance to provide operational guidance all point to fundamental challenges beyond normal cyclical pressures. This isn't a carrier experiencing temporary headwinds. This is a legacy operator whose cost structure has become misaligned with their revenue-generating capability.
That wraps our analysis of American Airlines Q1 2026 filing. Remember, this analysis is for informational purposes only and should not be considered investment advice. Always consult with qualified financial professionals before making investment decisions. I'm Sarah with Mike. Thanks for listening to Aviation Intelligence Weekly.
Thanks, Sarah. We'll be back next week with more aviation market analysis.